Did you know that personal information, like addresses and phone numbers, is collected and sold by data brokers across the internet? Fortunately, Aura steps in, scanning the web, sending you alerts, and requesting the removal of your info when found. Get a 14-day free trial of Aura's full toolkit, including ID theft protection, parental controls, and more at aura.com/safety. That's AURA.com/safety.
One of the first lessons I learnt when I began this podcast, that it was no longer necessary to just look at individual shares and companies. ETFs, or exchange-traded funds, provide a vast smorgasbord of investment options, but the number of choices can also create confusion. So today we welcome Kanish Chugh from ETF Securities to explain ETFs to us.
No, cheers. Thanks, Phil.
Kanish, before entering the investment management industry, you worked in the financial media industry at both the Fin Review and Insto publications.
Yeah,
how was that?
It was a good entrance into the market. Actually, when I finished university, I finished around the time of the GFC.
Yeah.
So it was a tricky time to find a job. So it was a matter of finding something linked to the financial services area, and that's sort of what I was able to do. So it was a good experience seeing from the other side.
Yeah.
But so that was one of the best things for me, was actually trying to work out where in finance I wanted to be, and that was specifically within asset management.
Yeah. So why asset management, and what is asset management?
Yeah, so asset management essentially is, when you consider anyone's super funds, that is the management of those funds.
Yeah.
That is asset management. So there are asset management companies. So their basically main role is to manage funds on behalf of investors. So someone like a Fidelity, for example. Fidelity, they have a very successful active Australian equity fund. Now, they've got a portfolio manager, they've got a team of analysts, and that's what their role is, making sure that they make the best decisions from their perspective to achieve the outcome that they're targeting.
So one of the terms you hear coming up is active and passive.
Yes.
What's active mean?
Yeah, so active basically means that there's someone making a decision. Whether they're using bottom-up research, so basically they're looking at all the companies on the ground and they're really trying to identify trends, and from that they're driving that research up to make a particular company decision. They're making some form of active decision around the portfolio. So when I talk about an active Australian equity manager, what they're doing is they're saying we're going to build a portfolio of 25 to 30 stocks.
Australian stocks, Australian equities. Equities are stocks, are shares.
Stocks, exactly. Shares equals equities equals stocks. That's really what. And I was speaking with friends on the weekend, exactly the same thing I was having to explain to them. What is an equity? It's a share.
Yeah.
And so that's what an active manager is doing. They're sitting there going, okay, we're going to create a portfolio of basket of stocks or shares, but we're going to choose, based on what their belief is.
And those managers, they've got all sorts of strategies, don't they? There's a million strategies.
There's so many different types of strategies. You've got strategies from being, sometimes we use the word fundamental, and what that means is bottom-up research. So they're fundamentally doing the research on the stocks, and that is what is driving their decision around to buy one stock over another.
And so fundamental is when they're looking at the actual numbers of the company.
They're doing the guts of the research. They're going out to the mines and actually doing site visits of BHP and Newcrest, and actually seeing with their own eyes what's happening, and sitting with the management and trying to understand what their philosophy is and what their strategy is for the growth. And I guess that's the difference where you've got passive. So what is passive investing? Now, passive is was started by Vanguard over 60 years ago. And it was the idea, and it's sort of the Warren Buffett style sort of theory, which is why buy individual stocks when you can just buy the actual market? So passive investing really takes that decision making out. So there is no portfolio manager sitting there going, I will buy BHP over Rio, or we should buy CBA over ANZ. What passive investing is saying is you buy a benchmark. That is what passive investing is. It gives investors the ability to just say, I want the market, or I want that index exposure. And that started to evolve. And that's where ETFs have really come into its fore, is the evolution of indexing. And therefore, we've seen this big growth over the past 20 years globally in exchange-traded funds.
Okay, tell us about an exchange-traded fund.
An exchange is your stock exchange. So if you flip the words in reverse, it's a fund that is traded on exchange. Simple as that. So it's open-ended. Now, what does that mean? It means that I can continue to buy units. There's no sort of limitations around how big the fund can get. So therefore, what it means is investors can then buy and sell an ETF as quickly and as easily as they do a normal share. So if they have a Telstra share, if they have a Commonwealth Bank share, if they have an ANZ share, they buy and sell that via the CommSec accounts or via their stockbroker or financial planner, for example. An ETF all have a code attached to them. An example is we've launched a India equity ETF, and the code is NDIA. And so simply a person can put in NDIA and they can look and say, okay, well, I can buy and sell that as I do a normal share. Majority of ETFs in Australia are physically backed, so they hold the underlying equities or bonds or commodities or currencies. So they're very simple, they're very transparent, and all the idea is it allows the investor to buy and sell that as they do a normal share.
And it's got one other big advantage as well, hasn't it?
Yeah, I guess, well, there's a few big advantages. One is cost. Because we're tracking an index, we're not making any decisions. We're simply saying, you're buying the index. So an example there is iShares. Now, iShares is a big global ETF provider. I think they're the second largest in the world. They've got a S&P 500 ETF. Now, what is the S&P 500? That's the US index. So that's the largest 500 stocks on the US market by size. They've been able to offer that ETF for investors for 0.04% management fee. Now, that's
so cheap.
That is so close to zero. It's unbelievable. But it's so cheap. We look at our infrastructure ETF, our global infrastructure ETF that we have, and the ticker, the ASX code or the ticker is the other word that we use, is CORE, CORE, and that is 0.45%. So 45 basis points, or 0.45%. Now, if I looked at an active infrastructure fund, you're paying 1% plus.
Kanish, are there any risks involved in buying ETFs?
Look, I think there are risks with any investment. So whether it's, the risk of the particular product, investors need to be aware of what they're buying. So for investors, they really need to come back to, what am I actually investing in? So I get laughed at, but I sort of say, look under the bonnet, to really lift the bonnet up and understand an ETF is going to track an index, but what is that index? Now, an example there is European equity ETFs. So I want Europe share exposure, but how do I get it? Okay, let me look at the ETFs that are available. Now, there are about 5 ETFs that do that. They offer some form of European equity exposure, but by the way, they all offer a different type of exposure. So you've got some there that offer broad Europe, so they include the UK, they include Switzerland. You've got one there that offers really broad Europe in terms of 1,600 stocks, and one that's really concentrated, about 350 stocks. And then we've got a product in a European Euro Stocks 50 index, so that's the main index for Europe. The code is ESTX, and that is no UK exposure. So that's the only ETF on the market that has no UK exposure. So with Brexit happening, if you think, okay, well, what should I do? I don't want that currency exposure. I don't want the UK market. Let me look at that. Or if an investor says, well, I want some UK exposure, well, what products are available? So that's just in European equities. And so that's the key thing there is investors for ETFs really need to lift the bonnet up and understand what's underlying. And, always speak to the fund managers. So speak to the ETF providers, whoever they may be. They're happy. There's a lot of resources available to them. And I think the problem is there's so much resource and content that investors can look at. So sometimes the easiest thing is pick up the phone and actually speak to one of the team. We've got retail investors that will call us up and just ask us, look, I need to understand what is this, robotics and automation ETF that you've got. Tell me a bit more about it. Or your physical gold ETF, is it actually physically backed? Is it not? Just tell me more about it. And obviously we will try and help investors as much as possible. Speak to a financial professional is always a good thing. Try to get some insight from them as well.
I think that's one of the things that ETFs originally, or when you start thinking about ETFs, you think, oh, this is very easy. I don't have to worry and think about individual stocks anymore. But then, of course, there's so many different kinds of products and so many different ETFs investing in different sectors and different parts of the world that it can become confusing as well. But I first came across you via Chris, your CEO,
yes,
at the ASX Investor Day, and he gave a great presentation, and it was about robotics and artificial intelligence, his presentation. That was one of the most exciting things because you realise that in Australia, there's a whole range of industries that are not represented.
Yeah, so I think that's a key point around ETFs is the evolution of ETFs has meant that, so 16 years ago when ETFs were launched in Australia for the first time, it was very simple. It was market trackers. So I'm going to buy the S&P 500, or we launched the first gold ETF around the world. So I just want gold exposure, so physical gold. So gold price moves up, that's what I get. But then you start to see the evolution of indexing, the evolution of ETFs. And what that has meant is ETFs gives you the ability to really drill down to a sector or a theme or a region that previously for investors here in Australia, they couldn't do. So at ETF Securities, our big, mantra is providing intelligent alternatives. So what we want to do is give clients the ability to say, if I want to take that thematic exposure, I want to drill down into those areas, I can do that now. So we launched Robo, which is the ROBO, which is that ETF that Chris, my CEO, was speaking about. And that looks at robotics, automation, and artificial intelligence. So the whole idea is it's a disruptor. So what are we going to have in the future? And how do I also invest in that? And that's the idea of something like Robo is it's looking at stocks that generate revenue from this megatrend of robotics, automation, and artificial intelligence. So robotics and automation has been around for about 50, 60 years. We've seen it in manufacturing where Ford can produce a vehicle every 10 seconds. Or you've got a company like Porsche who have decided they don't want to create automated processing lines, but what they want to do is they want to use robotics and automation to still have manual workforce, but help them. So they have exoskeletons on them to allow their workers who are getting older to lift heavier things and put all those things in place. But it's not in certain countries. For example, in South Korea, there's about 1,000 robots per 10,000 employee workers. So you've got a lot of robots. In China, it's about 200 robots per 10,000 employees. So there's still a lot of growth to move in the emerging markets around the use of robotics. But then you move outside of the industrial space and manufacturing space. What about in consumer? What about in healthcare? So, I'd be interested to know about how many of the listeners here would actually have a robotic vacuum cleaner. And, so in the Robo ETF, we've got an exposure to a company called iRobot. Mm-hmm. And they produce the Roomba. And the Roomba is one of the biggest manufacturers of robotic vacuum cleaners. Now, that is just an evolution. But what that's done is they've taken the different aspects of technology that has been developed in the automotive space, sensing software that's developed for cars, utilized it in a little vacuum cleaner, and they're selling that for about $1,000, and you can have that. But it's also got artificial intelligence software where the robotic vacuum cleaner, when you set it off, and you can do it via an app, and it goes directly to the messiest spot because it knows that that's a spot that I need to clean first, and then I will map out my room and clean the room. So it's things like that in this mega trend that we're really, it's just growing and it's continually going to increase. But how as an investor do I get exposure to that? In the ETF that we have, the index we track is the Robo Global Index. And that's got over 90 names of companies that generate 25% or more revenue from this megatrend of robotics, automation, and artificial intelligence. And it's companies that as an investor, I don't know enough about. I'm not going to be on top of, and I don't know, should I invest in, John Deere? What did John Deere? I didn't realize John Deere was a sort of tech company.
Yeah, you think they're just a tractor company, but it's
exactly.
Amazing to see that they're world leaders in artificial intelligence. Who would have thought?
Who would have thought? Yeah. They're using sensing software to be able to map out the different areas of the crops and the water density so that they can efficiently disperse water. And then on the healthcare side, robotics and automation and AI really is only just grafted the surface. So, we're not even going deep down in healthcare, and we're seeing massive benefits. So Intuitive Surgical is a US company. They produce what's called the Da Vinci machine. And I would like everyone to actually go onto YouTube and put DaVinci Machine in and actually search the machine. And they've got some really interesting videos. They've got a video of this machine which can be operated by a doctor from the next room or from across the world, and it can make minute precision surgery, mid-body surgery. And it can literally, there's a video on there which shows it peeling a grape and then stitching the grape back together. Robo actually forms part of what we call the future present range. So within that range, we've got a global tech ETF, technology ETF. So the ticker is TECH, TECH. And that is just your developed, current, established technology companies. So the Googles, the Apples, the Facebooks of the world. And then that's our present. And then we talk about the future. And the future is robo. So robotics, automation, artificial intelligence. Can't get that exposure. And the whole idea is I'm not buying individual stocks, I'm buying a theme. And the theme is that I know that this will be a disruptive theme. It will be a theme that will continue to grow, and that is what I would like. Alongside that, we've got a battery and technology and lithium mining ETF. So again, talking about renewable energy and electric storage and electric vehicles. So that ticker is ACDC. And then you're talking about healthcare. So biotechnology. That is the future for healthcare. Mm-hmm. And so we launched an ETF last year around biotech. Because
in Australia you could buy a CSL or Cochlear, but they're tiny compared to
what is globally. There's a stock in our biotech ETF. So the ETF, the ticker is CURE, CURE. But there's a stock in the index, and it's just US biotech stocks. The top 120 stocks by size in the US. And there's a stock in there which has a largest market cap size of about $120 billion. Now that's larger than CBA. But we here in Australia wouldn't know that. Australia investors generally have a home bias. We like to invest in the domestic economy. We like to invest in our own market. But that sometimes could be a negative for our portfolio because we're very limited in what we have, as you said, Cochlear and CSL. So what I would suggest to investors is diversify. Look outside of the Australian market. Look at the ETFs that can help benefit your portfolio. And if you still want to take the domestic stock exposure, you can do that. But it complements what you're doing by buying the theme of what you really want. You really want biotech. You're not trying to buy individual stock risk. You're buying a thematic. You're buying a sector.
Have you ever Googled your own name? Prepare for a shock because your personal info, including addresses and phone numbers, is all out there. It's all harvested by data brokers and sold legally. Aura is a personal digital security service that scans the internet for your sensitive information and provides a full suite of privacy-enhancing tools. For a limited time, Aura is offering listeners a 14-day free trial at aura.com/safety. That's AURA.com/safety to learn more and activate the 14-day trial period.
I think that's one of the exciting things, isn't it? That, in the past you'd be trying to get a diversified portfolio.
Yeah.
And you'd buy, some of the banks, some of BHP, some of Rio. That's your traditional Australian style of investing, bit of Telstra and so forth. But it's not real diversification. But now your portfolio can encompass so many more different areas and so many different industries in the world.
Or I guess so you've got thematics like robo or battery tech and ACDC. Okay, that's that, or sectors. But then even regions. So, we talk about European markets. Europe makes up more than 20% of global markets. But how many investors here in Australia would consider buying Europe as a region? And, Europe has a lot of value. It's got a lot of potential. And, it's quite a stable economy. Yes, fine, we've got Brexit and a lot of that's happening. But Europe specifically, core Europe, Germany, there's a lot of positives in there. But would I take Europe as an exposure? But then you look at emerging markets. So in the recent years, we've had a few emerging market ETFs launched by competitors. We've had a few Chinese equity ETFs launched. And one in particular example would be VanEck. It's one of our competitors, has launched a new China ETF. So the ticker is CNEW. And that's looking at, retail, tech. It's looking at the next evolution of Chinese companies and that sort of that big trend. So that's a great example to say, well, I can take broad, emerging market exposure via ETF or an unlisted managed fund, mutual fund, and then I can complement it with this specific ETF. And that was one of the reasons. So we launched India Equity ETF. We're the first provider to do that here in Australia. So it's the first listed India equity exposure, and the ticker is NDIA. Now that is just a pure market exposure. So it's just tracking the 50 largest companies in India. Mm-hmm. We're saying we're just going to give you the market. We believe the market, India, it's a growing economy. Forecasted 7.5% growth for next year, 7.7% growth for 2021. Big reforms have been put into place. It's structurally working. It's structurally building consumption. It's
very young population.
A median population of India is 28 currently. By 2030, the median age will be 32. So 75% of the workforce is currently under 30.
And a very dynamic
and
well-educated.
Well-educated. They adopt technology, in big swathes. And so this is going to be an area where you say, okay, well, how do I get exposure to that?
Some of the listeners that we have, some are older and have got self-managed super funds or are about to retire. Some are very young people as well, and they want to gain exposure. So what's the advantage to the young person, for example, who's just starting out to getting into these sectors, and what's the advantage to the older people that have got their self-managed super funds?
Well, I think, for anyone, they've got to assess what their risk profile is, and that whether you're young or old, your risk profile may end up being the same. Who knows? So they've got to assess what their risk profile is, and how diversified is their portfolio, and they've got to look at that. So they've got to really understand what they're wanting to achieve. That's the key goal there, And so I think for a young investor, the ETFs provide a really easy, low-cost solution, because within a few ETFs, you can have a really diversified portfolio. And that's really useful for someone that doesn't have as much funds available to them to invest. ETFs also have options available for them. So you've got products that provide yield. So they're not always about, we've talked a lot about robo, we've talked a lot about, India or China, etc. So really growth stories, but, you can be very defensive as well.
So yield is income, isn't it?
Yield is income, exactly. But, Australians love income. They love dividends. They love their franking credits. But do I need to just focus on Australia for income? Can I look outside of that? Now, we've got a US equity income product, and the ticker is ZYUS, the code. And the yield on that to the end of June, just on the index, was 5%. And I think that's the key point there, is that's what ETFs are offering for any investor. So you've got products that are available that are suitable for those that, low cost building blocks for the really early investors that just want to build something, and then they can take a particular exposure into, something of interest to them, like robotics and automation. Or, I was talking with a friend on the weekend about, she wanted to be quite ethical in her investing, and we've got ethical ETFs available on the market now as well. So she can do that. So she can be building blocks and then take some ethical ETFs. But then as they build up their portfolio, they can then start to be a bit, specific and targeted and tactical, as we would say. Can
I just add something to what we were talking about before, and that's about John Deere and their artificial intelligence, what they can actually do to individual seeds when the tractor is going around and planting the seeds. Can you tell us a bit about that, please?
Yeah, so I guess what it was trying to do is, so it would take the tractor. The tractor firstly is automated, so there's no driver in there. It's already mapped out the crop. So it knows the lines that it has to go. But what it's doing is it's actually going through using facial recognition technology on seeds. So
seeds are that unique, are they?
Seeds are that unique, exactly. So when you think about our fingerprints, they're all unique. And even a seed is unique. It's got its own fingerprint, essentially. So it's using facial recognition technology, and it's going through and it's mapping out and saying, okay, these seeds require more water, these seeds require less water. They're at the different stages of growth. And then it's dispersing the water accordingly. And I think that's what we forget is, robotics and artificial intelligence and automation, we're at this precipice, there's this tipping point where you're just going to see this big evolution, but it's not going to be in industries that we previously have thought of. We talked about the robot vacuum cleaners, the John Deeres of the world. So John Deere is buying more sensing companies and, artificial intelligence companies and data analytics companies, and it's buying actual tractor companies. So would you classify John Deere as a tractor company, or would you classify John Deere as a tech company? So it's interesting to see, but I, as an investor here in Australia, would have no idea about that. And that's why I buy into those sorts of ideas, the thematic ETFs, where I know the theme will cover that in some way, shape, or form.
Okay, forgetting about ETFs, but if you were to buy stocks, and it's about diversification, and we all know how important diversification is, but to be mathematically diversified, you need 30 stocks in your portfolio. How does that work?
So I think it's the mathematical theory that if you had 5 stocks, you're not diversified. If you had 10 stocks, you're not diversified. Especially in Australia, you're not diversified, because when we look at an Australian basic investment portfolio, everyone goes for the big 10, your big 4 banks, or your Telstras, your BHPs, your Rios, your Wesfarmers, your Woolworths. Are you really diversified? You don't have any technology exposure within that. You don't have any real consumer discretionary exposure within that. You don't have any regional exposure within that. But that's just on shares. We just talked about equities just in terms of your diversification. You haven't even looked at, different asset classes. Should you be buying fixed income? Should you be buying commodities? Across equities, you need to have more than just 5 or 10. You can't be concentrated, and you need to build out the portfolio. So the ETFs solve that purpose. They give you an ability to buy one unit in a ASX 200 ETF gives you exposure to the 200 largest stocks on the Australian Stock Exchange. 1 unit of that ETF. So all of a sudden I'm diversified. But then I need to diversify further. So portfolio diversification. So in your investment portfolio, you shouldn't just be diversified across, your, what I would say is just equities or shares. You need to look at other asset classes and really build out a properly diversified portfolio so that you can ride out through the ups and the downs. When you talk to a financial planner, a lot of them don't talk about how much they're going to give you in return, what they can achieve. A lot of the time they talk to you about protecting your investment. And that's the whole idea about diversification. So diversify a bulk of your portfolio, really make sure that it's safe. You're safeguarding your nest egg and you're growing it slowly. And then if you want to take bets, take your bets, but do it with a smaller allocation that if you're happy to lose is what I say. Friends would ask, or people ask, should I take this? Should I take that? Well, there's a risk in everything. And, taking a particular risk, you need to have a strong base first. And if you can take that risk, then you should. Then that's entirely up to you.
Because higher risk means higher returns.
High risk means high returns. Exactly.
Yep.
But an example, we've got a Palladium ETF. Now, it's the best performing ETF across all 200 products on the Australian Stock Exchange.
Yeah, and who even knows what Palladium is?
Yeah. So I was having to explain this to someone the other day. And, Palladium is essentially a precious metal. It's short in supply. It's only mined in South Africa. And so there's limited supply. There's high demand for it, especially as emission standards for cars, for petrol vehicles around the world increase.
How is palladium used in a car?
So it's used in the catalytic converters. So basically the conversion of the petrol into, a more cleaner, output. The amount of palladium used in one vehicle is about $200. So very small. But when you talk about how many vehicles are being produced for countries like China, India now, the US, Europe, you're seeing many more petrol vehicles being produced. So there's an increased demand in palladium.
So we've got a listener question. This is from Barry Cunningham. I'll be retiring in 3 years' time, and I'm interested to know more about investment options to keep my wife and I funded for at least 30 long and happy years. I'll be going to a financial advisor, but I want to know more about the products they recommend. I'm not a professional investor, but I don't want to be blindly taking advice without having a certain level of knowledge myself. How can I start to know what I need to know? Thanks for the question, Barry.
So, Barry, I think first thing is the Australian government's got a very good website in moneysmart.gov.au. And I think first point is go there. Go there because it actually explains what a managed fund is. It explains what an exchange traded fund is. It explains what a LIC, a listed investment company, is, or listed investment trust. Really use that source first to give you some basic knowledge. Also, in terms of choosing your financial planner, you can search your financial planner on that particular website, and it actually gives you the history of the financial planner. And so you can see, have them been caught up with any issues or, etc. So I would suggest that's the first point of call. The other side of it is go to, do Dr. Google, literally go to some, so if your financial planner comes to you, so you've done that, you've gone to, the government website, you've got some basic knowledge around what a managed fund is, what an exchange traded fund is. Do your own research. Each of the fund managers in Australia, or majority of them anyway, especially the larger ones, have a lot of information on their website, as I said before.
So, Kanish, you've got a 2-year-old son, haven't you?
I do, yes.
At what age are you going to start teaching investing?
Well,
how young can you start?
Yeah, it's funny. I think, from the age of probably 5, I can probably start talking to him about saving. And the age of probably sort of 6 or 7, I think probably 7, when you can start to say they start to want something, you can start to sort of talk to them about, well, if you want this, you can give me something and you can try to invest it, try and build to get that. So saving and investment go hand in hand. So I would probably start from about the age of 5 or 6, probably. Yeah.
So how old do you think he'll be before he gets his first ETF?
I think he'll probably be younger than that because I've probably bought it for him already.
Which one have you got for him?
So for him, I've actually just got basically a collection of ETFs. So it's a very small, basic portfolio of 5 or 6 ETFs. Mm-hmm. So things like physical gold. So the GLD ETF, he can be a little bit more risky. He's got a longer term horizon.
A very long term horizon.
Yeah, so things like NDIA and so forth. The growth plays. Mm-hmm. He's not looking for income at the moment. He's looking for growth. Yeah. So we can be a bit riskier. Mm-hmm. with some of his investments.
His risk profile is very high according to his father.
Exactly, according to his father.
And a very aggressive 2-year-old.
Yeah, very aggressive 2-year-old. Yeah.
Okay, so tell us a bit about ETF Securities, about where we can get in touch with you and what resources you've got for the listeners. And
yeah, definitely. So, we talked about ETFs in the market. They've been around for about 16 years, but ETF Securities has been around for pretty much 16 of those years. We're the second oldest provider in Australia.
Is it an Australian company or
Australian-owned company? Mm-hmm. Started by a man called Graham Tuckwell. So he's the founder and still the owner of ETF Securities, and he's actually quite a big philanthropist. He's got a foundation with the Australian National University in Canberra, and really for us as ETF Securities, as I said before, we want to provide the intelligent alternative. And I guess the point around that is we're wanting to be a partner for investors. So we want to make sure investors have everything at their fingertips and all the information to make the best decision for them. So we do a lot of content. We do a monthly newsletter, which has education, it has market news, it has research and product news. And so that's probably a key thing there. So for investors that want to be on our newsletter, they can go to etfsecurities.com.au. They can subscribe. And as I would say also is go to the website and have a look under the resources section. There's a lot of really useful information. And if you go to the contacts page, you can actually see the numbers there. Feel free to call us. We've got a team, just in the sales team alone, we've got 6 people, happily to take anyone's call during market hours. So any questions around ETFs, any questions around trading of ETFs, what should I do? Should I not do this? We'll happily try and help you out.
So 16 years, you must have been pioneers in the field in Australia.
The world's first physically backed gold product. So around the world, there was never a gold product that gave you physical exposure. So Graham Tuckwell, launched that here in Australia, and that product was then replicated over in the US and the UK.
Yeah, I've got friends who get excited about gold because one friend has bought something where you can actually get the gold, I think, or
yeah. So with our product, you can actually redeem for the metal if you would like.
Wow! No one does your own bullion.
Yeah. If people want to, they can, but there are costs associated with that.
Yeah.
But because we physically back our product, so the code is GOLD. It's the world's first physically backed gold product. We have over $740 million worth of gold sitting in a vault attached to the investors for the unit holders. So the unit holders there...
Hang on, just go, so how much gold have you got sitting in the vault?
Over 700 million Australian dollars.
Where's this vault?
It's in London. So, the custodian for that product is HSBC. So it sits in a vault with HSBC.
So if it's open-ended, does that mean you've got to keep on putting more gold into it?
Yeah, exactly right. Yeah. So, we've seen, big inflows recently into the product, and we keep buying more gold, and we'll continue to do that. And that's the thing. It's attached to the end investor. So the end unit holders, that is their gold. We can't touch it as ETF Securities. All ETF Securities are doing, providing a vehicle for the investor to invest in it. So doomsday scenario, things like that, they've still got their gold sitting in the vault.
So you can go over to London and pick it up.
If they would like, yeah, exactly.
Kanish, thank you very much. It's been a real pleasure talking to you today.
No, thank you so much.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any shares based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. And I'd also like to say a big thank you to Christopher Soulos of Garlic Breath Studios for all the fantastic help with the music production.
Did you know that personal information, like addresses and phone numbers, is collected and sold by data brokers across the internet? Fortunately, Aura steps in, scanning the web, sending you alerts, and requesting the removal of your info when found. Get a 14-day free trial of Aura's full toolkit, including ID theft protection, parental controls, and more at aura.com/safety. That's AURA.com/safety.